So let's start with ETF adoption, because in the US, 72% of those surveyed plan to increase their use of ETFs. Clearly, they're not bothered by the persistent rise of passive products or the potential liquidity issues that certain investors, a lot of hedge fund managers, let's face it, increasingly voice.
Mm-hmm. I think you might have stolen my thunder here at the top of the show where you said even in this period of heightened volatility, ETF trading is really going off without a hitch. Not to say they're not immune from risks. They're certainly a commingled investment product tracking the broader market. So we will expect to see prices depreciate. We might see spreads widen out in the secondary market. But that secondary market really acts as a liquidity valve for investors when they want to add positions or when they want to get out, as we've seen today in heightened volatility. Mm-hmm. So that 70% is a great stat. Here we are 30 years into the ETF era, and we still see investors globally saying they plan to increase allocations because of that consistent experience they're having in trading, and also the versatility. ETFs are sort of a Swiss Army knife. You can get fixed income exposure, you can hedge your portfolio, you can get broad beta at very low cost, so very popular with investors.
Okay, and how you decide to split your investments along those lines is dependent a lot of times on model portfolios. Mm-hmm. This is a global survey that you've conducted, and if there's one thing that investors around the world seem to agree on, it's the value of these model ETF portfolios. Who puts them together and how are they used?
Yeah, it's an interesting dynamic that we really wanted to tap back into this year in our 7th annual survey. So we wanted to go out to the investor population, get a better sense for what they were doing with these models, how they were accessing them. 70% kind of jumped out at us as well. It was one of our more surprising findings. Basically, these are really just alternatives or wrappers to drive an asset allocation model. Mm-hmm. So increasingly, and we've seen over years, they're hardly new. They've been offered by private banks. They've been offered by large intermediaries and broker-dealers as a way to drive asset allocation strategies within sort of a single wrapper. Increasingly, they're built and supported by underlying ETFs in those models. So it's really a good opportunity, one, for ETF issuers, our client base, to identify new distribution trends and potential channels to promote their product, but also design their own models that they may offer to advisors, to other intermediary partners as well. So sort of two trends there happening in the model space.
Why do investors even need advisors then? Can't they do some of it themselves?
Well, they can, and investors can access. If you're self-directed in one of the big brokerage houses here in the States, you can access models offered by that broker-dealer, and you can do that independent of an advisor. But what we've also seen is with some of the regulatory burden that advisors are now encountering, their focus is somewhat tilting away in some pockets from asset allocation. So some advisors themselves are starting to use these models. Many design their own, but they can also use third-party tools to further their asset allocation and product offering for their end client.
All right, let's talk transparency, because about 90% surveyed say they want an ETF to disclose their holdings daily or weekly, more frequently than a lot of these active non-transparents are coming onto market, which will likely disclose probably monthly or quarterly, and if they do a daily disclosure, it'll be kind of scrambled. It'll be a proxy. What does this tell you?
Interesting dynamic here. I think, one, it suggests that while many of these new structures were approved in 2019, we're still waiting for the first ones to come to market. So for me, the big question here is, does the T in ETF really mean transparency, or we're waiting with bated breath to see? I think in these structures, we did ask investors their views on transparency. It showed us that investors have certainly become accustomed to the opportunity to look at the portfolio each day and see those changes day over day over day. Whether or not they actually use it is sort of the question, and these new structures coming in offer additional data sets for investors in lieu of those daily updates. We think, by and large, investors, if they can get the liquidity that we talked about in these products, as well as the products themselves offered at a competitive price, they'll see these as any other ETF in the market.
All right, I got to ask you about ESG as well, because when it comes to what kinds of ETFs people want more of, ESG comes in first in Europe, second in China, but kind of fifth in the US, which I guess matches flows. Why do you think this is? Why is there such a big diversion?
There's a tale of a couple markets here, clearly. I think when you look at Europe and what we're beginning to see take root in Greater China is a little bit more of a top-down focus on kind of standardizing ESG, not only for investors, but for the fund companies themselves offering these products, and more consensus being driven around what equates to ESG, what categories it would fall in. In the US, we sort of have a vacuum right now around that. So it was not necessarily surprising. We saw investors in the US, about 69% say they plan to add ESG at large, not necessarily ETF specific. But to your point, they were ranked number fourth in terms of, or fourth or fifth in terms of where they wanted to see a new product. So that's a market we're going to be watching closely to see if that demand or interest equates to flows as we go through 2020.